Hi and welcome to Swissquote's Daily Market Talk. It's Tuesday, January 14th. The bond sell-off continues to weigh on market sentiment across the global financial markets. The dollar continues to advance against most major peers. All eyes are on the US PPI numbers today, with hope that the numbers won't look worse than the market expectations. So the bond sell-off on Monday remained on the headlines and in every discussion across the financial markets. The US 2-year yield spiked to 4.42% level yesterday. That's the highest level since July before easing. The US 10-year yield hit 4.80% mark for the very first time in more than a year before easing. As such, the bond yields in the US today, on average, will return to their pre-subprime crisis levels, and bond world's heavyweights expect the US 10-year yield to reach that 5% psychological mark sooner rather than later. Here in Europe, while the German 10-year yield advanced to the highest level since last summer, and the French 10-year yield actually spiked past the 3.45% level. There in Japan, the Japanese 10-year yield also jumped, and it jumped to 1.25% level. So that's a level that hasn't been seen since 2011, guys. So the bond sell-off across the financial world is being fanned by the worries of exploding debt levels in developed economies that lead to political turmoil and political uncertainty, combined with the major central banks' inability to bring inflation levels down to their 2% policy targets, with several economic and political and also geopolitical developments that might cause a U-turn in consumer prices globally. So here we are today. The yields around the world are rising, except for China, and expectations of further interest rate cuts from some major central banks around the world are melting fast, and obviously equities are under pressure. So in this context, the S&P 500 plunged yesterday below its 100-day moving average level to the level where it actually ended on November 5th, just before Donald Trump's nomination as the next US president. So the sell-off below the 100-day moving average in the S&P 500 attracted some dip buying yesterday and led to a meager 0.16% gain by the end of the session. But the Trump gains are now fully wiped out. Then Nasdaq 100 extended its losses below its 50-day moving average and is aiming to test the 100-day moving average to the downside. The Dow Jones Industrial Index, however, was better a bit yesterday, near the levels it was trading when Trump was elected president, supported by a rally in energy stocks on the back of rising energy prices and also a rebound in financial stocks ahead of the upcoming bank earnings announcements this week. Then, the American mid-caps are also near the Trump election levels these days, while the small caps of the US are already below these levels. In Europe, the STOXX 600 index dived yesterday below its 50-day moving average, while the FTSE 100 index slid despite a rise in energy and bank stocks. Why? This is happening simply because the deteriorating outlook for further interest rate cuts from the Fed is actually weighing heavily on the global market sentiment. And for the base case scenario of this year to unfold, so for the stock market rally of the US big techs to further broaden beyond the technology companies and ideally beyond the US borders, well, the yields must come down and let the lower borrowing costs benefit to more cyclical and non-technology pockets of the market globally. But the yield's positive direction today puts that forecast at risk. So if yields around the world continue to climb and they remain high, the rally that we see in the market is unlikely to extend beyond the technology sector, and even within the technology sector, it could falter due to already high valuations. Because Magnificent Seven stocks, for example, well, these companies cannot really afford bad press at the current levels, but the news on the wire these days aren't great. So yesterday's news were clearly not great. Information for example, reported that Nvidia's customers face delays in getting their chips, and they have even cut some orders. So the stock fell 2% at yesterday's trading session, while Apple's iPhone sales dropped 5% globally last year. The Chinese rivals increased their market share. The AI applications on these devices are not coming fast enough, and upcoming trade war between the US and the rest of the world, including China and Europe, is not painting a rosy picture for the iPhone maker. Apple shares also traded below their 50-day moving average yesterday for the second consecutive trading day and tipped a toe below their 100-day moving average level. So technically speaking, the major support here is seen at $223 per share mark, which is the major 38.2% Fibonacci retracement level that will distinguish between the continuation of the actual positive trend in Apple shares and a medium-term bearish reversal. Now, zooming out of Apple and the tech and coming back to the macroeconomic picture globally, market sensitivity to major economic data from the US and elsewhere will likely rise as uncertainties rise and appetite weakens around the world. So, having a close eye on the economic calendar is obviously essential to understand what's moving the markets these days. So, in the sense due today, the US will release its latest PPI numbers for December, and the headline PPI in the US may have risen from 3 to 3.4% in December, and core PPI is seen rising from 3.4 to 3.7% during the same month. Now, note that this expectation was significantly lower at yesterday's trading session, and I'm intrigued to be honest. But anyway, the numbers are the numbers. Rising price pressures in the US is obviously no good news for the Federal Reserve, those, and stronger than expected figures could obviously further accelerate the sell-off that we see in the US Treasury markets and support the US dollar. The US dollar index continues to push higher, mind you, and the euro dollar, for example, remains under a decent selling pressure below the 103 mark on the back of these rising hawkish Fed expectations, while cable is in a free fall mode on another round of appetite loss from investors in British government's fiscal plans and amid the rising bets for a further sell-off in sterling. So positions in the option market actually suggest that some investors are now betting that sterling could slip to 1.12 level against the US dollar if Rachel Reeves, who is just back from her Chinese trip, if she cannot restore confidence rapidly. This being said, well, there is right now an increasing amount of triggers in the market for the contrarians to join the game and slow and eventually reverse the US dollar rally. The hedge funds, for example, well, they have increased their bullish US dollar positions to the highest level since 2019, and net speculative short positions in the euro, for example, also appear to be stretched. Therefore, we could eventually see some major currencies regain some field against the overbought US dollar, but obviously the economic data from the US will say the last word for price moves. So all eyes are on this week's inflation data. Happily for some, though, the earnings season is just about to kick off this week, and the earnings could eventually give a certain relief to some investors. Now, better than expected earnings could obviously slow a potential sell-off in the global equity markets, but note that the pressure is clearly building on equities, and the year may not be as optimistic as many Wall Street analysts out there had penciled in for this year. Because note that the expectation for the fourth quarter earnings of the S&P 500 are relatively high. The S&P 500 companies are expected to announce an almost 12% earnings growth and around 14% if we factor in the earnings beat, according to FactSet. And in Europe, the STOXX 600 companies are expected to eke out a 10% earnings growth, excluding the energy companies. But the growth could slow depending on the amplitude of the rise that we see in energy prices right now, and also the severity of the trade tensions with Donald Trump's America. So this is all for today. I'm İpek Özkardeşkaya and thank you for joining me and thank you for all your beautiful and supportive comments. I hope this episode of Market Talk has been helpful and it has been insightful to you. So please do not hesitate to leave your comments, your reactions, and your questions below as usual. Follow us on Instagram, on X, and on LinkedIn for regular market updates. Subscribe to our YouTube channel for daily market comments. And please don't forget to hit the like button on these videos to let us know that you enjoy them. So I will meet you again tomorrow. And until then, good day trading.